Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Well, good day, friends. Hey, I'm late today. This is Tuesday, July 5th, 2011. It's getting on to about 4:50 in the afternoon. No big shakes because you had your rally in the metal markets. Now, you can see it right here. Gold was up $30. Silver was a powerful rally, as was copper. This copper market's been the powerhouse. It's come from the $4 level right on back up almost 10%. One heck of a rally. And they keep talking that, in the copper market, China. China is the game. And if they're going to restock, watch out. And it's a big price they'd have to pay up here to restock, so I don't know. This is the September silver chart. It's a daily bar chart. It really goes back, as you can see here, to April, and then you come on up through May and June. And we have been going very much sideways since the market peaked right at the very end of April, and it came down at the beginning of May, and it's been stuck. Base building is what I'd like to think it is, not a top. And I read a lot of reports this week, silver's still going a lot lower. Got my doubts about that. I think that silver is one of these commodities like gold that needs some time, get through the summer, and then push into the end of the year is what I'm looking for. So I think silver did a lot of important action today, and I had been the guy that was a bit bearish and very concerned about the price action. Doesn't mean you're not still concerned, but let's take a look at the charts. This is a regular bar chart, and on it I'm going to put on my proprietary swing line study. Here's what I think is important. Today's rally high got up to 35.69, which is higher than 35.16. So we have a pattern of a higher high. The break low at 33.47 is higher than the previous break low of 33.39.5. So what is the swing line study doing? And you can see, because it marks, if you will, the apexes of highs and lows on it. And you can put more apexes. They'll go all the way back if you turn that feature on. What you've got, according to at least what we would call trending analysis, is higher highs and higher lows. Definition of an uptrend. You have to filter that. Do you have volume? Do you have the market over key areas? Where are you? The first area I'm going to look at is price. And in terms of price, 35.31 is the 18-day average of closes. That is my line in the sand. When the market closes over that number, I'm looking for potential buy signals as long as the swing line is pointing up and a few other indicators kick in, but we're going to go through them. So number one, you closed over that today. On pullbacks, I'm looking now for support at 35.31, and what I don't want to see is a move back under yesterday, Friday's low of 33.47. It is about a $2 risk. That's not for the faint-hearted. If you're trading a full-size contract, it's $10,000. Keep that in the back of your mind. In terms of resistance, and why is it resistance, not support? Because the 45-day average in blue is above the market, and so is the 100-day moving average. So if these prices were under the market, they'd be support. You have the 18, the 45, and the 100. And they are lined up in a bearish configuration with the shortest term, the most medium term, and the longer term lined up stacked, one under the other, if you will. So I'm looking for resistance at 36.26 and 36.91.5. But the fact that the market has got the swing line up and it's over the 18-day average gives the, if you will, the momentum to the upside until 33.47 is taken out. Let's look at Bollinger Bands. Just the other day, and I'm going to come back to this if I can when we did one of these videos, we were right here, and this was Monday. And I said, now the big thing is, are they going to be able to push and get this long bottleneck of a Bollinger Band to widen out like they can do at different times? I had my doubts about it, but you have to be fearful. Resistance would be the 18-day average on rallies. The market pulls back into the Bollinger Band the very next day, starts a small rally, as you can see, and I'm talking about the resistance being the 18-day average of closes. The market drops back on Friday. So I'm looking for resistance as of the close of business on Friday at 35.38.5. The problem in going short was that number is above the last swing line low of 35.39. As far as I'm concerned, it's not a short sale. And if you take out 35.16, it negates the current downtrend. It's exactly what you did today. Now, the market should be opening soon, and we'll get an idea of what that is. But formally, I see this market as now being neutral with a slight upside bias to it as long as it stays over the 18-day average of closes. In terms of momentum, the slow stochastic study, notice how the red line has turned back up over the brown. So you've got some upside momentum in the market, and as I see it, the risk is to not get back under 33.47. If the market can get through those moving averages, I'll look for resistance at the Bollinger top at 37.38. Pretty simple definition. In the gold market, the market negated the possibility of falling off the cliff today, at least technically speaking. It is still not in the bull camp. It is under the 18-day average of 1520. The last rally high was 1514.80. We went today to 1518. So we have a pattern of a lower low and now a higher high. So we're widening out a trading range like this, taking the top part, trying to lift it up, and I'm looking at the resistance at 1520.90. In terms of buying it on a seasonal basis, there are no seasonals right here. Silver has an advantage. It gets a seasonal to the upside at mid-month. And I'm talking historical. Do seasonals always work? They have limitations like every single chart study, but I pay very close attention to them. This is the market that I've been talking about that I thought had broken out, and I want you to look what it's doing to the Bollinger Bands. This is what I'm hoping silver will do ultimately to the upside. It will take that thin Bollinger Band neck that was here. The market at this point has a higher high and higher low. You might say, well, Ira, what about, would you recommend this to people? Here's the dilemma. If you buy over this day's high, which is the right move, buying over the this would be the 412.30 area. That's the number. And this goes back to last Tuesday. The risk is back to 405.05. Anyway I cut it, it's a $1,500 risk, and that's too much for me to tell a customer to get in, and there are no viable options, heavily traded options in the copper. So you got to be, I think, a contract trader here. So the market comes up, and that's the ballgame. Gets over the Bollinger Band. Now the question is, like silver did, can it push itself? Here's the difference. Notice that these numbers were just sitting in the 60s and 49. Silver, when it got to the bottom, was already into an oversold area. So this has the capability of pushing a bit on the market, and this is last Wednesday. Market goes up day 1 over the Bollinger Band. Day 2 is Friday. Day 3 is today, and we'll see where tonight goes. You're also getting overbought. I'm looking on pullbacks in this market as buying opportunities. I'd be wrong in my thinking if you take out the 405 level, and I'm looking for support and a chart pattern to develop ideally in the 415 area that becomes tradable in terms of dollar risk. I don't know if it will or won't do it, but I see an uptrend there. In crude oil, well, so much for going in with all these stocks report, but you knew that before. Let me show you. This was the market last Monday, not yesterday, a week ago. And what you're looking for is you've got patterns of lower highs, and what else do I teach you? That if you're under a Bollinger Band, the odds of staying under it are only 2.5% of the time. The market's already widened this neck out, so you got to be cautious. You're also trying to get an embedded stochastic, which you accomplish. Now, if the red line gets over 20, you lose the stochastic being embedded. But what else happened? And this was Tuesday. This high had already taken out that one. You've already negated the downtrend. The only shot you got at getting it back in place is to immediately go down and take out the previous day's low, which you didn't do. Instead, you make a run up on last Wednesday. So what's the pattern? You've got a higher high, a higher low, but you're still under the 18-day average of closes. The market starts playing around that 18-day average on Thursday and Friday. Now, the key to the market is to take out 95.84. If it can do so, then the market's going to continue on with, in my opinion, the swing line making the higher high. And if 93.45 isn't taken out, at least you know your risk is back to that number, one tick under it. Still a $2.50 risk, way beyond the risk factor that I teach customers to trade with, but it's exactly what happened. So on pullbacks, I'm going to look for support at 95.27. The problem is still have a $1.80 risk, and that is awful big, and I think too rich to take. I'll end on this note. This is the differential between the crude and the Brent, so the WTI crude and the Brent. One of the things that happened last week that was interesting is the volume in the Brent, which is traded on the ICE exchange, overtook that on the NYMEX for the first time in a long time. Now, open interest didn't do it, but the trading volume did. Was that because it was the 4th of July? Whatever. It doesn't matter. What it's proving to me, and what I'm garnishing from this, is that the Brent crude is starting to become the more popular contract because it's the world price, not just the U.S. price. Doesn't mean that the WTI crude isn't going to be a good contract. That is not what I'm saying. What I'm saying is popularity, and now because of all these prices and going forward, the Brent crude, it's here to stay, and it's going to be traded, I think, very importantly as a futures market, and it's got a big future ahead of it as far as I can see. Now the question is, where does the market go from here, and that's the $95 million question. Well, I guess in this case it isn't. It's going to be more like the $100 a barrel question. We'll see where it all goes. I'm Ira Epstein. I'll see you tomorrow. Have a good trading day.